Welcome to the deep dive. Ever watch the business news and just wondered why CEOs suddenly slam the brakes on hiring? Or maybe why prices change seemingly overnight?
Right.
Well, this deep dive is definitely for you. We're looking past the headlines today, really digging into the fundamental economic forces that, well, dictate how businesses survive.
Yeah, we've pulled together insights from a whole series of business lessons, really focused stuff, and we've kind of distilled the mechanics behind it all. The idea is to give you the tools, really, to start predicting market shifts, not just reacting when they happen.
Absolutely. So our mission today is to quickly unpack 5 huge interconnected influences. We're talking interest rates, inflation, exchange rates, unemployment, and overarching all of that, the business cycle itself. These are basically the levers that force every business out there, from your local corner shop right up to massive global corporations, to constantly tweak their strategy.
And getting a handle on these 5 is, honestly, it's the shortcut. You see a company make a big, maybe sometimes painful-looking decision, like cutting back investment or going for an aggressive takeover.
Yeah.
It stops looking so random. It starts looking like, well, a logical response to the economic gravity pulling on them. We want you to see that gravity at work.
Okay, let's kick things off with the biggest force then, the sort of rhythm of the whole economy. The business cycle. Because the economy, it doesn't just grow straight up, does it?
No, not at all. It's much more like the tide, You get these periods of rapid expansion, the booms, high tide, and then periods of decline, recessions, which is like the tide going out.
So a boon is high tide, fast growth, lots of jobs, incomes are going up, and people are out there spending. Businesses feel good about expanding.
Exactly.
We saw a pretty clear example of this, didn't we? Like in the UK back in the early 2000s, house prices were soaring, consumer confidence was, well, sky high.
Yeah, people felt wealthier, and crucially, they spent like they were. But the challenge for businesses then isn't just sitting back and enjoying the ride. It gets complex. Demand's high, sure, but so are the problems. You've got wage costs shooting up because everyone's fighting for skilled workers.
Especially in certain sectors, tech maybe.
Oh, absolutely. Tech, specialized fields. And then you've often got inflation pushing up your raw material costs too. So the smart thinking isn't just about expansion. It's managing those tight margins and actually getting ready for when things inevitably cool down.
So it's not just about spending big during the good times.
Yeah.
It's expansion, yes, new products, sure, but also really sorting out your supply chain now before the downturn eventually hits, kind of saving for the winter.
Precisely. And that winter, the low tide, that's the recession. Technically, it's when economic activity shrinks for 2 quarters in a row.
And what happens then? Confidence just vanishes.
Pretty much. Confidence evaporates, spending dries up, especially on the non-essentials, and unemployment starts ticking upwards.
Okay, so where do consumers cut back first? It's the non-essentials, right? Things you don't strictly need.
That's it. So huge pressure on anything discretionary. Think luxury brands, fancy restaurants, holidays, high-end gadgets. They suffer the most.
Right.
But the contrast is really interesting. Businesses selling absolute necessities, supermarkets, discount stores, basic services, they tend to hold up much better. They're more resilient.
Okay.
For the average company, though, the focus just flips entirely to survival cost control. But here's the fascinating bit. Recessions can actually be the best time for some strategic, maybe even aggressive moves.
Wait, hang on. Grow during a recession.
Yeah.
How does that work? Seems counterintuitive.
It's about spotting opportunity in the middle of all the distress. A recession forces companies to get ruthlessly efficient, sure. But more than that, it lets stronger firms negotiate really hard, get cheaper rent on property, maybe even buy up valuable patents or equipment from competitors who are struggling or going under.
Ah, I see. So picking up assets on the cheap, essentially.
Exactly. That's why some businesses actually come out of a recession much stronger than they went in.
Okay, so we've got the big rhythm, the cycle. But what's the main tool the central bank uses to try and, well, conduct that rhythm? Interest rates, right?
That's the big one. Interest rates are basically the price of money. It's what it costs you to borrow and what you get back as a reward for saving. And yeah, typically set by the central bank, like the Bank of England here.
So when the bank signals rates are going up, how does that hit the average person?
You feel it almost immediately. Borrowing gets expensive. Suddenly, saving looks much more attractive. If you've got a mortgage that's not fixed or maybe a lot on credit cards, your monthly payments can jump up quite significantly.
Right, which leaves less money for other things.
Exactly, less disposable income. So consumers tend to pull back on buying big things, houses, cars, major home improvements.
And businesses see that consumer pullback. And they react too.
They do. Why would you take out a huge loan for, say, a new factory or a big tech upgrade if the cost of borrowing just shot up and you're seeing signs that people are going to buy less anyway? So investment gets delayed.
Okay, makes sense. And the flip side, when rates fall.
Well, then borrowing is cheap. Saving doesn't pay much. So it encourages people to spend, maybe take out that loan for a car or home improvements. It often boosts sectors like real estate and tourism.
And businesses?
They're encouraged to invest in growth, maybe open those new stores, upgrade their systems. Falling rates are really designed to inject a bit of confidence, get the economy moving faster.
Now let's connect this directly to the other big money lever, inflation. These two seem like they're constantly in a tug-of-war.
They really are. Inflation is just the rate prices are generally going up, measured here by the Consumer Price Index, the CPI. It's that slow or sometimes fast erosion of what your money can actually buy.
Your purchasing power just shrinks.
Exactly. And high inflation is particularly brutal for businesses. It's often a double whammy. First, consumers cut back on non-essentials because their money doesn't go as far, so demand drops.
Okay.
Second, at the same time, the business's own costs are shooting up raw materials, wages, energy bills. It just squeezes profits from both ends.
And that creates huge uncertainty for planning, right? How can you set prices or sign long-term deals if you don't know what your own costs will be next month?
Precisely. It makes long-term strategy incredibly difficult, really risky. Which brings us to that standard response you mentioned.
The tug-of-war.
Yeah. When inflation gets too high, what do central banks almost always do?
They raise interest rates.
Right. They use that higher cost of borrowing to deliberately put the brakes on the economy, encourage saving over spending, reduce that demand pressure that's pushing prices up.
So the ideal is stable, low inflation.
That's the goal. Stable, low, predictable inflation is what lets businesses plan for the long haul with some degree of confidence.
Okay, let's widen the lens a bit now and think globally. Exchange rates. This is just about how much one currency is worth compared to another, isn't it? Like the pound versus the dollar or the euro.
Exactly. And it fundamentally shapes international trade. Let's take the British pound. If the pound is strong, meaning 1 pound buys you a lot of dollars or euros, what does that mean?
Imports get cheaper.
Precisely. Foreign goods become cheaper for UK consumers and, crucially, for UK businesses buying things from abroad. Think tech firms importing components or manufacturers buying raw materials priced in dollars. It lowers their costs.
Okay, that sounds good. But there's always a catch, isn't there?
There usually is. A strong pound is great for importers, but it makes life harder for exporters.
Right, because our stuff looks more expensive to people overseas.
Exactly. UK-made goods, whether it's cars or specialist foods or financial services, they become more expensive for foreign buyers. That can really dent demand from other countries.
Okay, so what about when the pound is weak? The opposite happens.
The whole situation flips. Imports suddenly become much more expensive. That increases costs for any business relying on foreign suppliers.
And that eventually feeds through to us as consumers, right? Higher prices in the shops.
It often does, yeah. But the upside is for the exporters. Suddenly, British goods look like a bargain to overseas customers.
Ah, so a weak pound can actually boost certain UK industries.
Definitely. Sectors like, say, car manufacturing or maybe high-end food and drink exports, they can become much more competitive globally. It gives buyers in the US or Europe a real incentive to choose British.
So for businesses operating internationally, this is something they have to watch constantly.
Absolutely, constantly. The key takeaway strategically is managing that risk. Any company trading across borders needs to monitor these currency fluctuations very closely. Many larger firms use specific financial tools, hedging, to protect themselves.
Hedging. Okay, for those of us not familiar, what exactly is that? Can you break it down simply?
Yeah, sure. Think of it like buying insurance for exchange rates. A business basically locks in a specific exchange rate for a transaction that's going to happen in the future.
Good.
So even if the pound suddenly drops or shoots up before they actually pay their supplier or get paid by their customer, they're protected. It shields their profit margins from those wild swings and lets them keep their pricing more stable.
All right, let's shift focus again from the financial mechanics to something very human. The labor market. Unemployment. The official stats, like from the ONS here, they tell us how many people are looking for work but can't find it. It's a key health check for the economy.
Yeah, it really is. And high unemployment, well, It's obviously devastating for the individuals involved, but it also has a huge knock-on effect. Fewer people with jobs means fewer people with disposable income.
Which crushes consumer spending.
Exactly. Especially on non-essential. So businesses in retail, leisure, restaurants, they feel that pain almost instantly. It often forces them into really difficult decisions, cutting costs, maybe even letting staff go, which then, of course, can make the unemployment situation worse. It's a vicious cycle.
Okay. And conversely, low unemployment. That sounds like it should be universally good news.
Generally, yes. More people working means more income circulating, which boosts demand. Businesses often see sales pick up, feel more confident, maybe look to expand and hire even more people.
But knowing what we've discussed, there's probably a challenge there too.
There is. Low unemployment creates a different kind of headache for businesses. Finding and keeping the right people, it becomes a workers' market.
Competition for talent.
Fierce competition. Businesses might face skills shortages in key areas. Workers are in a stronger position to demand higher wages, which can lead to wage inflation and other cost pressure. Suddenly, things like staff retention and training become much bigger strategic priorities, maybe even more so than just hiring.
I find the different types of unemployment really crucial here. It's not just one number, is it? For a business trying to plan hiring, understanding why people are out of work seems vital.
Oh, absolutely critical. For strategic planning, you really need to distinguish between a few key types. The first is cyclical unemployment. This is the one tied directly to that business cycle we talked about.
Right. Jobs lost during a recession, construction, maybe manufacturing.
Exactly. Those jobs tend to disappear when the economy dips, but the key thing is businesses expect them to come back when things recover. It's temporary, linked to the cycle.
Okay, what's the next important one?
The second, and often a much bigger strategic challenge, is structural unemployment. This isn't just a temporary dip, it signals a more permanent mismatch. It's where the skills workers have no longer line up with the skills needed for the jobs that are actually available.
Like, if an old industry declines, maybe coal mining or gets heavily automated.
Precisely. The skills needed in, say, coding or green energy are completely different. So those workers need significant retraining to find new jobs. For businesses, anticipating these big structural shifts is key to making sure they're investing in developing the right workforce skills for the future, not the past.
So understanding the difference between